Introduction by Jason Zweig. The introduction to The Intelligent Investor underscores Benjamin Graham's foundational role as the father of value investing and highlights the enduring relevance of his principles in modern finance. Jason Zweig, a financial journalist, frames Graham's philosophy as a counterbalance to the emotional turbulence of markets. Key themes include timeless wisdom. Graham's strategies, developed during the Great Depression, prioritize logic over emotion, urging investors to treat stocks as ownership in businesses rather than speculative tokens. Mr. Market. Graham's famous allegory personifies the market as an irrational partner who offers daily prices, sometimes absurdly high or low. Investors are advised to ignore Mr. Market's mood swings and focus on intrinsic value. Margin of safety. Central to Graham's approach is buying securities at prices significantly below their calculated intrinsic value, creating a buffer against errors or market downturns. Defensive versus enterprising investors. Graham categorizes investors into two groups. Defensive investors. Risk-averse individuals who prioritize capital preservation through diversified portfolios, e.g., index funds or blue-chip stocks. Enterprising investors. Those willing to dedicate time to research undervalued stocks or special situations, e.g., arbitrage or distressed assets. Zweig emphasizes that Graham's lessons are not about beating the market, but about minimizing losses and achieving consistent long-term gains through discipline. Chapter 1. Investment versus speculation. Graham begins by drawing a sharp distinction between investment and speculation, a theme critical to understanding the book. Definition of investment. An investment is an operation that, upon thorough analysis, promises safety of principal and satisfactory returns. Investors must base decisions on fundamental analysis, e.g., earnings, debt, and competitive advantages, rather than price trends. Speculation's pitfalls. Speculation involves betting on price movements without regard to intrinsic value. Examples include day trading, meme stocks, or chasing hot tips. Graham warns that speculation becomes dangerous when disguised as investment, e.g., overpaying for growth stocks. Historical context. Graham critiques the speculative excesses of the 1920s and 1960s, drawing parallels to modern bubbles, e.g. the dot-com era or cryptomania. He argues that markets are cyclical, and speculative frenzies inevitably end in crashes. Practical advice. For defensive investors, stick to low-cost index funds, bonds, or diversified portfolios of high-quality stocks. Avoid frequent trading. For enterprising investors, seek undervalued companies with strong balance sheets, but only if you're willing to put in the work. For everyone, ignore market noise. Focus on your strategy, not daily headlines. Graham concludes that true investing requires emotional discipline, patience, and a refusal to participate in speculative trends, even when everyone else is doing it. If you like this content, please give it a like and subscribe. You will help grow my channel.